In early 2026, a huge geopolitical crisis kicks off in the Middle East, and it's threatening to blow up the entire global economy. But what's really interesting here isn't just the conflict itself. It's how this event is ripping the cover off a fundamental, hidden truth about the price of oil. And you know what? That's not really an exaggeration. The number you see on the news, the one that pops up on your screen, well, it's only one half of a much, much bigger story. Because during this crisis, the oil market literally split in two. And if you can understand that division, you can understand how energy and money actually move around the world. And just look at this. This shows the massive gap that opened up. In March of 2026, the price for a barrel of oil you could get delivered immediately, what we call the spot price, absolutely skyrocketed to $126. But at the exact same moment, the price for a barrel to be delivered just 6 months later was way down at only $70. So how on earth can the same exact thing have two completely different prices? To figure that out, we have to first understand how the market is supposed to work in normal times. Okay, so before any crisis hits, the oil market actually runs on a pretty logical set of rules, and it's all driven by something called a futures contract. Now, this is absolutely crucial to get. Most of the trading in the oil market, billions and billions of dollars, isn't for physical barrels getting loaded onto a ship today. No, it's all about traders making bets and locking in prices for barrels that will be delivered weeks, months, or even years from now. It's a gigantic, complex market for oil tomorrow, not oil today. So, in these normal, boring times, the market is in a state called contango. It sounds complicated, but all it really means is that oil in the future costs more than oil today. And why would that be? Well, think about it. If you buy 1,000,000 barrels of physical crude oil, you can't just, leave it in your garage. You have to pay to store it somewhere, in massive tank farms, or even on a giant super tanker. Those are real hard costs, and the industry calls them carrying costs. The market prices that in, so it makes perfect sense that you'd expect to pay a little bit more for a barrel in 6 months to cover all those expenses. And this, right here, this is the engine that keeps that whole contango system running. It's actually pretty simple, but really powerful trade. A big trading house can buy the cheaper physical oil today, rent a supertanker to just let it float around for a few months, and at the same time, sell a more expensive futures contract to deliver that same oil down the road. The difference between those two prices, minus the cost of renting the ship, is a locked-in, almost totally risk-free profit. It's this activity that keeps the market orderly and that price curve pointing up. But, and this is a big but, this normal market has a huge downside, especially for regular people like you and me who are trying to invest in oil. This state of contango creates a hidden structural problem that a lot of people fall into without even knowing it. I know that sounds harsh, but a lot of popular oil ETFs, like the big one, USO, are built to give investors exposure to oil prices. The problem is, they have a massive structural flaw when the market is in contango. See, they don't actually hold physical oil. They just hold a portfolio of these futures contracts, and that exposes them to a constant grinding problem. It's called roll yield decay. Think of it like this. The fund is holding a contract for oil delivery next month. As that date gets closer, it has to sell that contract because there's no way it can actually take delivery of millions of barrels of crude oil, and then it has to buy a new contract for the following month. In a contango market, that means they are constantly selling a cheaper nearby contract and buying a more expensive further out contract. They are systematically selling low and buying high every single month over and over again. It's like a constant financial leak that just drains the fund's value. And the cost of that leak is staggering. During periods of steep contango, it's not unusual for these ETFs to lose 8 to 13% of their value per month just from this decay. It means you, as an investor, can be totally right about the direction of oil prices. You can say oil is going up and be correct, and still lose a ton of money because of the way the product you're using is built. So that's the normal world of contango and its hidden traps. Now let's get back to 2026, where a geopolitical earthquake doesn't just shake the market, it completely shatters that reality. The whole thing ignites on February 28th with airstrikes on Iranian infrastructure. In retaliation, Iran's Revolutionary Guard moves to blockade the world's most important oil choke point, and they start attacking commercial ships. By April, the whole situation just spirals out of control into this full-blown double blockade as the U.S. Navy moves in to counter Iran. The physical flow of oil is suddenly under extreme threat. And the scale of this disruption is just immense. The Strait of Hormuz is the pathway for about 20% of all oil shipped by sea across the entire globe. Shutting that down is like clamping a major artery of the global economy. And this map really shows you the vulnerability. I mean, look at how narrow that passage is. At its tightest point, it's just 33 kilometers wide. That's it. All it takes is one regional conflict in this tiny little sliver of water to put a fifth of the world's energy supply in jeopardy. And that's exactly what happened. This sudden, terrifying scarcity of actual oil completely inverts the logic of the market. All the normal rules, they go right out the window. The market flips from contango into its polar opposite, a state of crisis known as backwardation. This is a total 180. In backwardation, the spot price, the price for oil right now, becomes way, way higher than the futures price. The entire market is screaming that it is desperate for physical barrels immediately, not in 6 months. It no longer pays you to store oil. In fact, it pays you an enormous premium to sell every last drop you have on hand, right this second. This market structure is basically a giant red distress flare. It's signaling that refineries are at risk of running out of crude, that global supply chains are breaking, and that the physical commodity itself has become incredibly precious. The premium isn't for some paper promise of oil in the future, it's for having a real barrel in your possession today. And this had a staggering real-world effect. With so much oil trapped in the Persian Gulf, the demand for tankers to move any available crude from anywhere else just exploded. The daily lease rate for a single supertanker hit a record $770,000 a day. That's not a price on a screen. That is the physical, real cost of logistics in a full-blown supply crisis. So this leaves us with a really critical question. The Hormuz crisis proved there are two totally different worlds. You have the abstract world of futures contracts and ETFs, and then you have the gritty, physical reality of tankers, choke points, and actual physical barrels of oil. Understanding which one of those you're actually exposed to isn't just an academic exercise. In a moment of crisis, it can be the difference between making a massive profit and taking a devastating loss.